Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've heard from the Reserve Bank that they've decided to go bigly and 50 basis point cut to the official cash rate, following on from their first cut at 25 basis points back in August. In October, they decided to up the ante a bit, go by 50. That seemed to be where everyone in the market had shifted in the sort of week or so leading up. It did feel a little bit like we were all jumping on the bandwagon. 2 weeks prior, everyone was sort of thinking 25, and maybe a few people were considering 50. The week before, sort of all of the bank economists moved to 50, and then one guy came out on RNZ and said, "Why don't we go 75?" And it felt like we were just ratcheting it up quite a lot. Looking through the statement from the Reserve Bank, it was only a monetary policy review, so we only got the statement itself and the record of meeting. We didn't get a full-on set of forecasts or any deeper analysis. But the Reserve Bank basically, I think, paraphrasing, said, well, look, the economy's weaker. And in fact, they said broadly, largely in line with where the Reserve Bank thought the economy was going to be, but they thought they needed to reduce just how much restriction there was on the New Zealand economy, needing to bring down the pressure a bit more. I mean, on the face of it, when they looked through in their announcement, they sort of said, well, look, we tossed up between 25 and 50, and we thought that 50 was the better move. They didn't really give us a lot to go on there in terms of why 50 was the bigger move. But of course, there's a lot of data that's come out since then. Why do you think, Gareth, they sort of opted for that larger hit coming through to cut it by 50 instead of that sort of more usual, more considered 25 basis points?
I don't think there's been any surprise in terms of how the economy has been performing. It has been weak. Demand conditions have been soft. Spending has been soft as well. About the only bright point we have had has been a lift in business confidence over the last 2 to 3 months, but that's sentiment rather than real activity. So demand conditions are weak. On top of that, you have had surveys around pricing intentions and cost intentions, which have come in quite weak in some cases, particularly in the retail sector, where that reflects, of course, a lack of household demand and spending, and so retailers looking to discount their products. And there is a sense that inflation is now well under control. I mean, I think the Reserve Bank's forecasts for the current quarterly inflation was sitting up at around about 2.3%. And we've seen over the last 2 or 3 weeks, as markets have refined their view, that it could well be that the number comes in below that. And so we are getting quite close to the midpoint of the Reserve Bank's target band with inflation. That's great news. But of course, with the OCR still up at 5.25 as it was prior to the meeting, that's still heavily restrictive in terms of the economy, and we'll continue to feel those effects of that sort of heavy restriction through over the next 9 to 18 months as well. So I get a sense that the Reserve Bank is feeling like, okay, we've done our inflation job. We weren't entirely sure that we'd get on top of it, but it looks like we are now. And now we've got to actually start getting things back to neutral and quicker than we had indicated previously. So it's almost a bit of a feeling for me like the Reserve Bank, they were slow on the way up in terms of raising interest rates and trying to keep inflation under control. We saw inflation ratchet up to 7%. It's almost a sense for me now that they're again a bit slow on the way down, and so having to cut more rapidly, more sharply than might otherwise be the case. It's of course, interesting when you look at their remit. They've got to keep inflation under control, of course, but there's a number of other variables that the remit says they've got to stop from having excessive volatility in those, and interest rates is one of them. I get the feeling at the moment the Reserve Bank is probably, if anything, just almost exacerbating the economic cycle a bit by, having too stimulatory policy, then too tight policy, and so we're sort of, quite swinging up and down, bit of a roller coaster ride, and I don't think we're quite through all of that yet. So I guess the question then becomes, they cut by 50 here, where do they go to in future meetings?
Well, and this is the question, right? I mean, if they've said that they need to up the ante on the pace of normalization, because that's what it is. It's not cutting necessarily to stimulate the economy. It is. But really, it's to go, well, things are too restrictive at the moment. We need to get them down to sort of neutral, to normally restrictive or normal levels of operation from that very tight setting. And I think that's where, implicitly the Reserve Bank, I think, by moving by 50 has said, look, we are going too slow. We were going too slow on the previous track. We need to get this thing cracking. The economy doesn't need as much restriction. We've got to clear through that wood a little bit quicker. Realistically, I think in the absence of any change in data, and like quite a material change, I think you'd have to look at the data and go, well, if inflation comes in that sort of 2.2, 2.3, 2.4% per annum mark, which is pretty close to that sort of midpoint, then there's no reason that the Reserve Bank should all of a sudden in November go, oh, well, let's go back to normal pace of 25 basis points. 50 seems to be the new normal, at least in a sense, for the moment. Perhaps a bit more management in 2025 as they sort of calibrate how to get down to that sort of new normal point. But in my mind, it's sort of 50 has got to be the starting expectation for the November monetary policy statement. Importantly, though, and I think there's not an unrealistic chance that they might even have to opt for that slightly bigger 75. Now, normally 75 basis point rises or cuts come through in November. It's often sort of a part of one, you've got the likes of your monetary policy statements, so you can do a sort of a more fulsome review of things. But most importantly, you're going into that summer period. You've got a 3-month, a 12-week break, whereas normally the Monetary Policy Committee reviews things every 6 weeks or so. So you need to almost be a little bit cautious of having enough insurance. On the way up, you don't want to sort of get too slow behind, so you almost do an extra one just to be sure and to be safe. And potentially this time you decide to go a little bit bigger again. Then in February, when you next meet, end of February, you've got a bit more data, but you've also got that ability to assess how the economy has responded to what would be 125 basis points of cuts. So I do think there's sort of a rationale for the Reserve Bank thinking about those bigger movements. Now, let's say it's 50 for the moment. It could be 75, but again, you've got some of that bigger stuff out of the way in 2024. You take the official cash rate down by a whole 100 basis points in 2024, maybe a little bit more if they opt for the 75. What does that mean for next year, though, Gareth? I mean, do you sort of see continued 50-50-50s, or do they start to move more into that 25 where they have to start to sort of, I guess, fine-tune their sort of adjustments a bit more as we get into the new year?
Look, it'll be a case of looking at the data, and they've given very little forward guidance in terms of, even what we should expect in 6 weeks' time, let alone out into 2025. And there is a sense that they are, quite reactive to the data at the moment. And you come back in February, like you say, and you won't have necessarily a good read of how the economy is reacting. But you'll kind of probably feel, have we done enough, or is there something in there that's happening, or do we need to keep going a bit more rapidly? So it will be a case of looking at some of those partial indicators early in 2025 and then going, okay, do we move back to the sort of fine-tuning sort of things and go 25 points at a time, or do we think we're still behind and we need to provide more stimulus for the economy going forward from here? I mean, at the moment, our interest rate forecasts are for the OCR to get down to 3.5 by the middle of next year. That will be 25 basis point moves through the first half of 2025. And beyond that, I guess the question then starts to become, well, what is a neutral OCR? I've heard people talk about 2.5%. I've heard people talk about things closer to 4%. So at the moment, 3.5 is maybe in that range, maybe still a little bit higher, which could suggest that there's downside risks to where interest rates go further out into 2025. I do think that parts of the economy will start to show a bit more momentum by the second half of next year, particularly the likes of the housing market. Not a lot, but those interest rates coming down do help in terms of debt servicing costs. And for households, they will start to free up more money in their budgets as they roll off higher fixed rates onto lower ones. So again, it's a question I think for the Reserve Bank of how well are they able to look forward and anticipate where the economy settles, where growth comes out the end of next year. They haven't shown a great deal of forward-looking ability so far, so it may well be that there's a possibility they do keep cutting even a bit longer than may be necessary to get that economy back on an even keel.
Now, I mean, the financial markets have been expecting sort of more aggressive cuts. To be fair, they've been expecting that since the start of the year, and the Reserve Bank told them where to go for the first couple of months and has now sort of acquiesced a little bit to the market, you might say. I guess, what do you think that means for sort of actual people's mortgage rates? We saw quite a flurry of cuts coming through already over the last year because of that sort of pricing in the market, just after August, in the August monetary policy statement, we'd seen just 25 basis points of cuts to the official cash rate. We'd seen 86 basis points of cuts to the likes of 1-year special fixed mortgage rates. So, I mean, is there a risk for borrowers here that some of those cuts are almost sort of already priced in, already front loaded a bit? Or do you think that'll sort of, there'll be a bit more pass or a bit more one-to-one matching on the downside too?
Yeah, it's a really difficult question because at the moment you've got quite a divergence between government bond rates and between swap rates in the wholesale market. Normally, swap rates they're a bit more risky than government bonds, so they tend to be priced above them. But they've really fallen, as you say, throughout the course of this year quite substantially. So financial markets for me look like they're pricing in a lot of the rate cuts already. It's not to say there won't be further mortgage rate cuts, but there is a risk that that sort of weird divergence that we've got between those two rates does close back up, and so either swap rates have to push back up a little bit relative to where government bond rates are, or the bond rates come down, in which case the mortgage rates probably aren't going to shift. So yeah, there's a lot priced in. There's probably, as I say, there's further sort of cuts from the Reserve Bank to come, but it's a question of how much more come through there. I have seen talk of people, saying you should float for a little while, and we know the floating rates are a lot higher, obviously, than the fixed rate, so you don't want to be on that rate for too long. But I think, given the degree of uncertainty we've got at the moment, you'd be well placed, I think, to look out 6 weeks and go, okay, well, let's just see what the Reserve Bank does in November. I don't think there's a great deal of upside risk in from the point of view that you're going to have to face higher mortgage rates after that if you wait. And then there'll be a bit more certainty, or at least things will be quiet over the 3 months over Christmas because the Reserve Bank isn't going to meet for a while, and everybody goes on holiday. So yeah, it's an interesting question for me. You look at the 2-year rate as a comparison, 2, 3, 4, and 5. I think they're all roughly the same level now, at about 5.7%. That suggests to me that the curve is getting close to bottoming out. There might be still further rate cuts to come through, but some of those longer term rates, not the longest ones, but the 2-year one, just starting to look a little more attractive than it has done for some time.
Well, and especially right when you've got, I think, in the month of August, about 40, just over 40% of new mortgage lending was for sort of 6-month rates. And you look at the 6-month rate compared to the 1 or the 2 year, and it's like, well, it doesn't look that fantastic in a sense, depending on where things move from here. So, like you say, I mean, people need to go and get some personal advice when they look at those things. But just because we are seeing interest rates fall in the near term doesn't mean that going on a near term fixed mortgage rate is definitely 100% the best thing, completely, without fail. So again, worthwhile doing your homework because there are some sort of bigger moves out there in the market. We'll continue to assess how all of the different interest rates move, both the ones that the Reserve Bank controls directly, the official cash rate, and what that means for the economy, but also mortgage rates, borrowing rates, broader, and savings rates, and what that means for people that have got cash in the bank on one of our future editions of Econ Talks.